Hello and welcome to the seventh episode of Fairness Protocol. Today we're going to talk about Uniswap, what Uniswap is, what it does, and the general idea around it. So, we're going to dive into what even is Uniswap. I will provide an example to explain what Uniswap is with it. In this scenario, you have some potatoes. Imagine you want to eat an apple. You go to a fruit store, give the store some money, and acquire some apples. In a spark of ideas, you decide to sell your potatoes so that you can buy the food you want anytime, even if the food is in another country. In this process, you used your money to trade for something you wanted and used your assets to acquire the ability to buy any food from anywhere else in the world. You weren't forced to travel to another country to buy a pineapple or a dragon fruit or go meet a coffee seed farmer in person just to get a coffee seeds you wanted. All right, so right now you can understand that you can use a middleman to buy whatever product you want, in this case, the fruit store. Let us proceed further. Now, imagine that you found that coffee seed farmer or pineapple provider, but you only have your potatoes with you. You desire to exchange your potatoes to get coffee or pineapples, but that can't be the situation since nobody knows how much of a potato is worth a pineapple or vice versa. So you need to change your potatoes to money and use that money to buy your desired product. Again, this procedure takes time and money just to go through. This isn't the case in Uniswap. Instead, the ideal situation of exchanging an Ethereum-based token with another Ethereum-based token is what makes Uniswap, just like the middleman we used earlier, the food store. Now, let us get into the ideal situation and discuss it. How can they receive the potatoes and give you what you want consistently with high efficiency? Imagine two baskets in that fruit store, one containing 100 apples and one containing 100 potatoes, so that anyone can take their desired product. This has a huge bug where someone can come and buy 100 apples and no potatoes, and thus robbing the store of the ability to sell any more apples. To solve this situation, the seller tells the apple buyer that if you want to buy an apple, you have to pay for 2 potatoes. After that, if you want to buy another apple, you have to pay for 3 potatoes. And how long do you think this can continue? Until someone comes and puts a lot of apples in their respective baskets. Now, here we can say the potatoes are Ethereum and the apples are any other token. We also know that Ethereum is a very popular token. When you give your potatoes, or Ethereum in this case, to the fruit store, or in this case Uniswap, they will give you tokens of your desire at the same fair price as Ethereum you just gave them. Here, the price of the token you're buying doesn't really matter since when you bought the token, the supply decreased and the price in return rises. And when you sell them, the supply increases and the price falls. Now, what is the cash pool in Uniswap? When a user wants to trade one token for another on Uniswap, they send their token to the relevant liquidity pool and receive the other token they want in return, based on the current exchange rate determined by the pool's algorithm. The exchange rate is determined by the ratio of the 2 tokens in the pool. When a trade occurs, the pool's reserves are adjusted accordingly. For example, let's say that there is a liquidity pool for Ethereum and DAI, and the pool currently holds 100 Ethereum and 10,000 DAI. The exchange rate, therefore, is 1 Ethereum equals 100 DAI. And if a user wants to buy 1 Ethereum with DAI, they would send 100 DAI to the pool and receive 1 Ethereum in return. The pool's reserves would then be updated to 101 Ether and 9,900 DAI, and the exchange rate would adjust accordingly. In Uniswap, LPs stand for liquidity providers. These are individuals or entities that provide liquidity to the liquidity pool and the Uniswap platform. Liquidity providers deposit an equal value of two different tokens into a liquidity pool, such as Ethereum and DAI, and receive liquidity tokens in return. These liquidity tokens represent that the LP's share of the pool can be redeemed for the underlying tokens at any time. By providing liquidity to a Uniswap pool, LPs earn a share of the trading fees generated by the pool. The trading fees are distributed proportionally among all LPs in the pool based on their share of the pool. The current fee on Uniswap is approximately 0.3% per trade, which is split among the LPs based on their contribution to the pool. For example, if a trade of 1 Ethereum for 100 DAI occurs in the pool, the fee would be 0.3 DAI or 0.3% of 100 DAI if the liquidity pool has 10 LPs. If all of those LPs have an equal share in the liquidity pool, each LP would earn 0.03 DAI in fees. 0.3 DAI divided by 10 LPs. Uniswap's cash pool works by allowing LPs to deposit equal values of two different tokens into a liquidity pool, which is used to facilitate trades through an automated market maker mechanism. LPs earn transaction fees on trades and can redeem their share of the pool at any time. So up until now, we know that Uniswap does two things. One is exchanging tokens for tokens with minimal rates, and the second is allowing people to make passive income by becoming LPs and staking tokens in the liquidity pool. So let's dive in to what exactly a liquidity pool is. Most of what was discussed was to familiarize you with how Uniswap works, and secondly, how centralized and decentralized exchanges differ. This ties into two things. Centralized and decentralized exchanges differ in their usage of AMM and order books. Centralized exchanges use order books to keep track of their transactions in detail, and decentralized exchanges use AMM or automated market maker. The ones mentioned use a permissionless system in which you don't need authentication to use their services. When people start to use centralized exchanges, several risks come with it, such as one exchange that got hacked and lost millions simply because two lines of code in the smart contracts weren't in the right place, where you could first exchange and then calculate the balance change in one's wallets. Another risk comes with the hacking of liquidity pools. We have a general understanding of what a liquidity pool is. It's where these liquid assets are, of course, where we refer to do our transactions and such, which we can get more in depth later in the episode. It is amid these procedures that comes the risk of getting hacked. Although, with the newer versions of the liquidity pools in Uniswap that are getting utilized in different exchanges, the risk gets exponentially lower. Yet there have been attacks before, such as vampire attacks and many other, which we will discuss again later in the episode. And there will still be attacks in the future, although with much less frequency. Another risk involves impermanent loss, which again ties into the liquidity pools and which again we will discuss much more in depth later in the episode. But generally, it's a phenomenon with the passive income which we talked about, which involved people pulling their assets in the liquidity pools and passively gaining small percentages of the income from every transaction done with their assets. The said phenomenon is the difference between people who pool their assets versus those who hold their assets. The difference is when people pool their assets, there is a chance that their assets go down in price, thus experiencing an overall loss called an impermanent loss. One more topic is admin keys, which exists in DeFi spaces, and among the 15 to 16 DeFis that are operating at the moment, there are only 3 DeFi systems that don't utilize an admin key. Admin key is part of the contract running the system, allowing one to move assets at any given point in the system. Uniswap doesn't utilize an admin key in any way. However, they use another method much similar to a backdoor in their system so that they can retain a bit of the centralized aspect of exchanges and move assets. This system will be discussed in the part where we talk about the fairness part of the whole system, and we'll talk about the system may or may not be fair towards the audiences and the people using this exchange. So, before we go further into the episode, let's get two more iterations of the whole Uniswap explanation so that we know that we understand and have a complete sense of what Uniswap is about. So, for that, we were going to be going into the centralized and decentralized exchanges and discuss them. So for centralized exchanges, imagine if we have a shop that belongs to the head of a village. You live in this village where people grow and harvest herbs or fruits. You have a wet farm where you grow and harvest your wets. Now imagine if at some point you want to diversify your palettes, so you want to have rice as a change. There's also a Mr. A in the village who has a rice farm and wants to buy some wet. There's also a Mr. B who owns a wet farm and a rice farm and doesn't even want to sell those products and wants to store them for his own further usage. In the shop we mentioned earlier, the shop with the baskets and where we could exchange things similar to Uniswap. In the shop, there's a ledger where everyone who wants to buy or sell something there writes the product and the amount in it. For example, A, who wants to sell his rice, has written that he wants to trade 1 kilogram of rice for 1 kilogram of wet. You, who want to buy rice, go there and naturally write that you want to buy, how much you want to buy, and what you want to pay, which in this case is 1 kilogram of wet for 1 kilogram of rice. Now, the head of the village, which we call Z, will review this book constantly and sees that there is a match between you and Mr. A. So he announces that there can be a transaction between the two of you where he gives you 1 kilogram of rice and you give them 1 kilogram of wet. And both of you and Mr. A, give a fistful of rice and wet to Z as a transaction fee, so to speak. So for every buy order, there has to be a sell order for the transaction to work. So if A doesn't want to sell his rice, you can't buy the rice for wet, and in return, the price of those products will change based on you and A and every other seller or buyer in that ledger. For example, A might say that he will give you 500 grams of rice for 1 kilogram of wet, and you agree. So you agree on raising the rice's value in the ledger. Z also knows everyone, be it you, A, or B, or anybody else in the village. But if someone comes to the shop that Z doesn't know, he won't let them use the shop even if they write anything in the ledger. For decentralized exchanges, though, it is a different story. We had the shop with the head of the village as its regulator and administrator for the centralized exchanges. But for decentralized exchanges, even though there is a shop and people exchange things in the shop itself isn't regulated by a head figure of any kind. It is instead run by anonymous and neutral workers who don't need to know you for you to be able to exchange there. There is also no ledger in this shop, and the ledger instead is replaced with a huge basket full of wet and rice. This basket is filled by B and other individuals who both have wet and rice in their farms, and the contents in the basket are in the form of safe keeps provided by them. Now, with the same scenario as we had before, you would want to buy some rice in exchange for some wet. You go to this shop and ask to get 1 kilogram of rice, and the neutral workers who might not even know you grab your wet, pour it into the huge basket of herbs, and then extract 1 kilogram of rice from the basket and give it to you. One question here is that with B not being present next to the big herb basket with its herbs in it, and only you and those individual in neutral workers being present in the shop, who decides the price of those contents? There's also exists an accountant in this shop called AMM who regulates and calculates the price of the contents in the basket based on how much of each herb is remaining in that basket. If there is more wheat in the basket compared to rice, they will higher the price of rice and vice versa. And for the benefit of B and anyone who stored their products there, there will be a small price for every transaction done with their products. Now, with all that said, we never discussed how liquidity pools work in depth. So, there are a bunch of liquidity providers who provide liquidity in the liquidity pool by adding currency pairs to the pool. We said that earlier. For example, either with an ERC20 token or even 2 ERC20 tokens. The first person who does this also determines the exchange rate of those tokens. For example, I'm the first person who deposits Maker and Shiba into the pool. I'm also required as the first provider for these couple of tokens to determine the exchange rate of these two tokens. I can put that rate higher than usual or I can put that lower than usual. However, that won't be a problem with the rate since there will be other people who also deposit these couple tokens, and albeit after me, with each deposit of those tokens, the rate slowly gravitates towards the optimal rate. That's why we say that we need arbitrage in this system. These people who provide liquidity for the pool will also get a cut after any transaction is done with their token pair, but only after the transaction has commenced. The transaction fees are also different for different tokens. If it's an exchange of Ethereum and another ERC20 token, for example, an exchange of an Ethereum with Link, the fee will be 0.3%, as we said, in the form of Ethereum. If it's an exchange of an ERC20 token to Ethereum, like Link to Ethereum, then the fee will be 0.3% in the form of the ERC20 token used in the exchange. In the first version of Uniswap, the only exchange available to users was the exchange of Ethereum for another ERC20 token, not the other way around. Only the one mentioned in the second version, however, the feature of trading an ERC20 token for another ERC20 token was added. This way, the exchanges became much quicker since we didn't need Ethereum to perform them. There also came a few quality of life changes to make trading easier and prevent the extraction of too many tokens from the system. By omitting Ethereum as an intermediary token, the fees also became much cheaper. In the third version of the Uniswap, the multiple issuance fees replaced the standard fee, meaning around 0.05% of the fee would go to the development team, and the return on investment of the investors also increased in the third version. So, let's wrap up the decentralized exchange versus centralized exchange topic and go to our next topic. To wrap it up, the difference between DEX and CEX in the common terms of crypto is as follows. DEX and SEX are two different types of cryptocurrency exchanges. DEX stands for decentralized exchanges and SEX stands for centralized exchanges. The main difference the two is the way they operate and how they handle transactions. A decentralized exchange operates in a decentralized manner, meaning that there is no central authority or entity that controls the exchange. Instead, DEX operates on a blockchain network, and transactions are carried out through smart contracts, which are self-executing contracts with the terms of the agreement between buyer and seller directly written into the codes. Because they operate on a blockchain, DEXs are often considered to be more secure and transparent than centralized exchanges. DEXs rely on liquidity pool and which are pools of cryptocurrency funds that traders can use to trade against. DEXs are usually non-custodial, meaning that the traders have full control of their funds and private keys. However, a centralized exchange is a traditional exchange that is owned and operated by a central authority or company. Centralized exchanges are centralized in the sense that all transactions are processed through a central server, which is owned and operated by the exchange because they are centralized. Centralized exchanges are generally considered to be more user friendly and have more features than decentralized exchanges. Centralized exchanges also have greater liquidity, which means that traders can buy and sell larger amounts of cryptocurrency. However, centralized exchanges also have greater risks, such as the risk of hack, fraud, or insider trading. So, in short, the key differences between the two exchanges are firstly in centralization. Decentralized exchanges are decentralized, whereas centralized exchanges are centralized. The next difference is in security dexes, and dexes are generally considered to be more secure than centralized exchanges because they operate on a blockchain and are non-custodial. This means that traders have full control over their funds and private keys. After security, we come to liquidity. Centralized exchanges have greater liquidity than decentralized exchanges, meaning that traders can buy and sell larger amounts of cryptocurrency. We have the user friendliness factor, in which centralized exchanges are generally considered to be more user friendly than decentralized exchanges with greater features and functionality. Fees also differ between the two, as decentralized exchanges are usually cheaper than centralized exchanges because they do not have to pay for centralized infrastructure and maintenance. And the final major difference is in transparency. Decentralized exchanges are more transparent than centralized exchanges because all transactions are recorded on the blockchain. This makes it easier to track transactions and prevent fraud. So, with the centralized versus decentralized exchanges explained and the Uniswap as a whole concept completely opened up, we should delve into the systems of Uniswap and what they actually mean. So, the first thing we're going to discuss is impermanent loss, which we mentioned a couple of times earlier. Liquidity pools consist of two types of tokens. One represents the cryptocurrency being traded, such as Ethereum or Bitcoin, and another token representing some other cryptocurrency as a liquidity provider, such as USDT or DAI. In exchange for providing liquidity to the pool, liquidity providers earn a fee on every trade that occurs in the pool, as we said before. Now, when a user trades a cryptocurrency, the price of the cryptocurrency changes based on the other tokens in the pool. This price change can result in a phenomenon called impermanent loss. Impermanent loss occurs when the price of the tokens in the liquidity pool changes, causing the value of the liquidity provider's tokens to be different than what they would be if they were simply holding those tokens. This happens because the way liquidity pools work, when a user trades one token for another, the pool's smart contract algorithm automatically adjusts the price of the tokens in the pool based on the supply and demand. For example, let's say a liquidity provider adds $10,000 worth of Ethereum and $10,000 worth of USDT to a liquidity pool. If the price of Ethereum goes up relative to the USDT, the liquidity provider's share of the pool will be skewed towards USDT. Similarly, if the price of USDT goes up relative to Ethereum, the liquidity provider's share of the pool will be skewed towards Ethereum. In both cases, the liquidity provider's tokens will be worth less than if they had simply held those tokens. This loss is called impermanent because it only occurs if the price of the tokens in the pool changes. If the price stays the same, the liquidity provider will receive their pro rata share of the trading fees without any loss. It is important to note that impermanent loss affects liquidity providers differently depending on the volatility of the tokens in the pool. If the tokens in the pool are highly volatile, there is a higher likelihood of impermanent loss. Conversely, if the tokens in the pool are relatively stable, the likelihood of impermanent loss is much, much lower. Next term we're going to discuss is AMM, or Automatic Market Maker. Before the advent of AMMs, traditional exchanges used an order book system to match buyers and sellers. However, this system has several limitations, including the need for centralization, market manipulation risk, and the order matching process's complexity. To address these limitations, AMMs were developed to provide decentralized solution for trading cryptocurrencies. AMMs are automated algorithms that use a liquidity pool to enable users to trade cryptocurrencies without the need for an order book. In an AMM, liquidity providers deposit equal amounts of two different tokens into a liquidity pool. These tokens then are used to facilitate trades between different users. When a user wants to trade one token for another, the AMM algorithm determines the price based on the ratio of the tokens in the pool. The AMM pricing mechanism is based on constant product formula, which states that the product of the number of tokens in the pool must remain constant. This means that as more of one token is traded for another, the price of the tokens in the pool will adjust accordingly. For example, let's say an AMM has a liquidity pool with Ethereum and DAI tokens in equal proportions. If a user wants to trade one Ethereum, the algorithm will use the constant product formula to calculate the price of the trade. If the pool has 100 Ethereum and 100,000 DAI, the price of one Ethereum would be 1,000 DAI, as 100,000 divided by 100 is 1,000. As more traders occur, the ratio of the tokens in the pool will change, causing the AMM algorithm to adjust the price accordingly. This means that the price of tokens in an AMM can fluctuate wildly based on supply and demand. Now, the next term we're going to discuss in the Uniswap environment is TWAP. What it stands for, we will talk about in a minute. So let's start. There exists an algorithm in Uniswap called TWAP, or Time Weighted Average Price, which helps prevent the system from getting hacked in between the tradings. What were even these hacks? Well, imagine that you want to swap some tokens in the system. You put in your orders and you transact the tokens and ultimately proceed to buy the token you want from the liquidity pool. There's a form of hack that happens during the process called a flash loan attack. A flash loan is a type of loan in decentralized finance or DeFi ecosystem that allows users to borrow assets without having to provide collateral or a credit score. This type of loan has to be paid back within the same blockchain transaction block, and it has become increasingly popular over the years for the ease of access and allowing businesses to access large amounts of money in virtually no time. And it's not even just an attack. It's that some people started abusing it in the systems with lower liquidity pools. How the attack works is like people who took the flash loan start buying tokens in the pool with lower liquidity. Then when the price raise as response to the token supply being lowered, those people who bought it with the loan money deposit those tokens in the same pool, and with the money they made through this process, they paid off the loan and made a profit with no starting capital. This kind of attack happened a few times to Uniswap before version 3, and after version 3, they implemented the TWAP strategy to make it extremely hard for the attackers to execute these types of huge price fluctuations over short periods of time. The way TWAP works is that it spreads out large trades over a longer period. By breaking up a large trade into smaller orders executed over a longer period, the impact of any one transaction on the market price of the assets is reduced, making it more difficult for a flash loan attacker to manipulate the price. This is the first episode of we discussing Uniswap, and there will be another episode after this, the eighth episode of Fairness Protocol, where we discuss the fairness side of Uniswap in much more depth. There will also be more terms related to Uniswap explained there, but for now, the three terms we discussed right now will be enough. With that said, let's discuss the difference between Uniswap's versions. As we just said, Uniswap had three versions, and things were vastly different between each of these versions and the next or the previous one. The first version of Uniswap, also known as Uniswap version 1, used a simple bonding curve mechanism to determine the price of assets. This meant that the price of a token was determined by a mathematical formula based on the ratio of the token and the reserve of the token in the pool. Liquidity providers could add tokens to the pool and receive a share of trading fees generated by the exchange. Uniswap version 2 was released in May 2020 and brought several new features to the platform. Most significant change among them was the introduction of ERC20 to ERC20 pairs, which allowed more flexibility in trading, and this version also introduced flash swaps, which allowed traders to borrow tokens from the Uniswap pool without collateral as long as they returned the tokens within the same transaction and the same block. In November 2020, Uniswap version 3 was released, offering an even more efficient and flexible automated market making system. This version introduced the concept of concentrated liquidity, which allowed liquidity providers to choose a price range for their liquidity instead of the entire price spectrum. This meant that more capital could be used more efficiently, resulting in an improved capital efficiency and lower slippage. In addition to the differences in the versions of Uniswap, several other interesting developments have occurred on the platform. One of the most significant developments has been the rise of decentralized finance, or DeFi. On Uniswap, DeFi refers to a new type of financial system that is built on top of blockchain technology and is designed to be open, transparent, and accessible to anyone with an internet connection. Uniswap has played a key role in the growth of DeFi by providing a decentralized platform for trading and exchanging tokens. Another interesting development on Uniswap has been the emergence of governance tokens. Governance tokens are tokens that are used to govern the protocol and make decisions about how it should be run. Uniswap has its governance token called Uni, which was distributed to users who had previously used the platform. Uni holders can vote on proposals to improve the platform and earn a share of the trading fees generated by the exchange. In the first version of Uniswap, Uniswap version 1, oracles were not used. Instead, the price of tokens were determined purely by the ratio of the token and the reserve of the token in the pool. This approach worked well for the simple bonding curve mechanisms used in Uniswap version 1, but it had some limitation when it came to more complex trading strategies. With the release of Uniswap version 2, oracles became more important because in this version, Uniswap introduced the ability to trade ERC20 to ERC20 pairs, which required the use of an oracle to determine the price of each token. Uniswap version 2 used Chainlink as its oracle solution, which is a decentralized oracle network that aggregates data from multiple sources to provide reliable and accurate off-chain data. Chainlink's oracles are designed to be highly resistant to manipulation and tampering, which is crucial for ensuring the integrity of the platform. The oracles are also able to provide data in real time, which is essential for ensuring that trades are executed at the correct price. In Uniswap version 3, oracles continue to play an important role. However, this version introduced the new concept known as TWAP oracles. TWAP, as we said, stands for time weighted average price, and it refers to an oracle that calculates the average price of an asset over a certain period. In Uniswap version 3, TWAP oracles are used to determine the price range for concentrated liquidity positions, which allows liquidity providers to optimize their capital usage and reduce slippage. But what is concentrated liquidity? In traditional automated market making systems, liquidity providers are required to provide liquidity across the entire price range of a trading pair. This can be an inefficient use of capital, as the liquidity provider may end up providing liquidity in price ranges that are unlikely to be traded, resulting in capital inefficiencies and higher slippage. With concentrated liquidity, liquidity providers can choose a specific price range for the liquidity, which allows them to focus their capital on the most active traded price ranges, and this results in improved capital efficiency and lower slippage for traders. In Uniswap version 3, concentrated liquidity is implemented using a mathematical formula known as the constant product curve. This curve is similar to the one used in Uniswap version 1 and version 2, but allows for more flexible liquidity provision. Liquidity providers can choose a price range and concentration parameter, which determines how much liquidity is provided in that price range relative to the rest of the pool. One of the key benefits of concentrated liquidity is that it allows for more efficient use of capital. Liquidity providers can target the most actively traded price ranges and concentrate their liquidity in those areas, which results in lower capital requirements and lower slippage for traders. Another benefit of concentrated liquidity is that it allows for more granular control over the risk management. Liquidity providers can adjust their liquidity provision based on market conditions and their risk appetite, which allows them to better manage their exposure price to price fluctuations and market volatility. Concentrated liquidity has also been linked to a phenomenon known as the vampire attack. The vampire attack refers to a situation where a liquidity provider can drain liquidity from a competing automated market maker by offering better incentives for liquidity providers. The vampire attack is made possible by the fact that liquidity in an AMM can easily be transferred to another AMM. This means that if a new AMM offers better incentives to liquidity providers, they may just be able to attract liquidity away from an existing AMM, causing it to lose liquidity and potentially collapse. Concentrated liquidity can exacerbate the effects of the vampire attack. This is because liquidity providers in concentrated liquidity pools can provide liquidity in specific price ranges. If a new AMM offers better incentives for liquidity providers in a specific price range, it may be able to attract liquidity away from an existing AMM with a concentrated liquidity pool, causing it to lose liquidity in that specific price range. But contrasted to concentrated liquidity, we have active liquidity. Active liquidity refers to the funds that are currently available for trading on the Uniswap decentralized exchange. Uniswap utilizes an automated market maker system that relies on liquidity pools rather than traditional buyers and sellers. These pools collect paired tokens like Ethereum USDC or USDT, as we mentioned earlier, that users can trade. Liquidity providers deposit an equal value of both tokens in a pool to facilitate trading. In exchange, they receive LP tokens representing their pool share. The ratio of the tokens in the pool determines the current price, and when trade occurs, the token balances automatically adjust while the LP tokens remain constant. Active liquidity denotes the value of tokens actually present in the pool at any given time. This fluctuates constantly as trades execute. If liquidity is too low, slippage and price impacts from the trades increase. Higher liquidity ensures smoother trading with minimal slippage. Liquidity providers can withdraw their funds at any time by burning their LP tokens, removing that value from the active liquidity. Other tokens, like large trades or sudden withdrawals, can also reduce active liquidity to incentivize providing liquidity. LPs earn trading fees from each swap that utilizes their contributed funds. Uniswap controls liquidity through their liquidity mining program, which rewards LPs with Uni governance tokens for staking their LP tokens in the pools. This encourages users to continue supplying liquidity to facilitate trading. Active liquidity is essential for Uniswap's AMM model. Monitoring this metric helps gauge the exchange rate's capacity for trades and the potential for slippage. Adequate active liquidity results in an optimal trading experience in Uniswap. Now, one more important question we have to ask ourselves before we end the episode, and that is, how does concentrated liquidity affect impermanent loss? And to explain this, as we said, impermanent loss occurs when price of the tokens in a liquidity pool diverges from the ratio they were deposited. LPs suffer impermanent loss if the price changes and they withdraw their liquidity. For example, if Ethereum is $1,000 and USDC is $1 when liquidity is supplied, the pool contains 1,000 Ethereum and 1 million USDC tokens. If Ethereum rises to $2,000, the pool now contains 500 Ethereum and 1 million USDC. Withdrawing now means missing out on gains compared to just holding the initial Ethereum. Uniswap version 3 introduced concentrated liquidity, allowing LPs to provide liquidity within a specific price range rather than in a 50-50 pool. This concentrates their funds around the current price. For example, if Ethereum is, again, $1,000, an LP can provide liquidity from $900 to $1,100. This means as the price fluctuates, a portion of their funds stays in the sink. Fewer funds diverge from the initial ratio compared to a wild 50-50 pool. Concentrating liquidity near the market price when supplying helps minimize the price divergence between deposit and withdrawal. This effectively mitigates the impermanent loss. LPs can reshape their range periodically if needed. Concentrated liquidity gives LPs more control to optimize providing liquidity and reduce impermanent loss relative to version 2 of Uniswap. This makes yield more attractive for liquidity providers on Uniswap version 3. And with that said, we finished the 7th episode of Fairness Protocol, which revolved around Uniswap, the general explanation, how it worked, and some of the general terms in the Uniswap environment. In the next episode, we will discuss Uniswap in even further detail, and we will open the fairness side of things, and we will then discuss the 4 pillars of fairness in the Uniswap. So stay tuned. Thank you for listening, and I'll catch you later. Goodbye.